Well, hey folks, it's Brad and Mike Anderson with Reliance Mortgage again with a Mike's Mortgage Minute, and we've been talking a lot about all the craziness out there and all these different types of loans. So why don't you give us a rundown of kind of these government loans and what's happening out there in the market and all these types that can be very overwhelming from time to time.
Well, getting a loan is like buying a car. There's that many choices out there. This in the government spectrum loan, which are government insured loans, there's 4 different types of loans. There's FHA, there's VA, there's USDA, which is agricultural property in smaller towns, and there's reverse mortgages, and all of them have different criteria as far as interest rates concerned, down payments concerned, ratios concerned, meaning that a debt to income ratio, and there's a reason why you'd want to buy a particular house with using those programs, the government programs, and all of them are insured by FHA or VA or some branch of government like Fannie or Freddie. Then there's what you call a standard Fannie and Freddie loan, which in the state of Texas is generally $417,000 is the loan amount. That's not the purchase price, that's the loan amount. So if you buy a $500,000 home, put down $75,000, yeah, $82,000, whatever the number is, you can get a conforming loan. Those rates are very competitive. Then you get into what they call a jumbo loan. Jumbo commonly being referred to a loan amount anything over $417 to $1 million. Those are a different category. Generally, they want a little more money down, although you can get by $800,000 home for 10% down all day long. And most lenders will tell you it's 20 to 25% down. And you have to have a 740 credit score. And all this stuff is just not true. That's what they have to offer. But it's kind of like going...
That's the box, right?
It's kind of like going car shopping. I'm not going to buy a car at the first dealership I go to. Well, that's not true. I have done that before. But it would have to be a hell of a deal. I have to be pretty confident. But it's like shopping for a car. You really ought to shop mortgage loans, even if you're pretty confident that your bank can do a loan for you at a competitive rate of interest. There may be a different program you want, like maybe not to put as much money down. Maybe your credit score is a little lower than they want, and they just turn your loan down. Maybe you didn't have enough down payment, they don't have that program. I mean, there is not a stone we, as loan officers around here, don't unturned to get somebody a loan. And there's so many different type of loans that, it's like it's like buying a car. There's lots of choices of cars, and there's also lots of choices. There's just not the standard 30-year product that everybody you call on the phone goes, yeah, I might go to town 30-year notice, boom.
Yeah.
Do you have any 10-year ARM notes? Well, nah, I don't like ARM notes, or they're too hard to explain. Or why should I tell them about the benefit of 15-year note? They want a 30-year note. Right. That's what they're ordering, so I want to give it to them, whether they want it or not.
Just push it through.
Yeah. So there's a lot of things going into mortgage lending, and I'm just saying that different lenders, even our lenders, the ones we make loans for, lender A may want a 720 credit score to get the best rate. Lender B may want a 680 credit score to get the better rate. Lender C may want a 740 credit score. Lender A may want 25% down. Lender B may want 10% down. Lender C wants 25% down. So it really doesn't make any difference what our lenders want. It's what you can do as a consumer. Right. In other words, if you call me on the phone and say, look, I'm buying $1 million house and I can't put 30% down, that's what a bank wants. I go, what can you put down? Well, contract can put down 15%. It's our job to go find you a loan with 15% down.
Right.
Our job is not to say you can't qualify because you don't fit in this particular box.
You don't fit in this box.
So it's just searching. And I was, we were talking earlier about interest rates. There are a lot of loans where you're better off to pay a lower interest rate. Pay a higher interest rate because your payments are lower, because the MI may be rolled into it, mortgage insurance may be rolled into it, or you may get a 80-10-10 and avoid mortgage insurance altogether. So interest rates are not the end of all. It's really the whole bottom line is what my payment is. And if you're better off paying a 4.5% rate of say $1,000 a month principal and interest as versus $1,100 a month for a 4% rate with mortgage insurance, you're better off to pay a higher interest rate and get a lower payment.
Yeah, because that mortgage insurance does nothing for you, right?
Mm-hmm.
Yeah, it's just money out your
bank. Open the window and throwing money out the door.
Yeah.
That's exactly what it's like.
That's another Mike's Mortgage Minute here with Mike Anderson, Reliance Mortgage.